During your employment years, taxation was straightforward. Your company deducted money from each paycheck and transmitted it to the Internal Revenue Service on your account. You never needed to consider it. April arrived, you submitted your filing, perhaps you obtained a refund, perhaps you owed slightly. The framework managed itself. The instant you retire, that complete framework halts, and nobody clarifies what substitutes it. There's no welcome to retirement correspondence from the Internal Revenue Service. There is no task list in the postal delivery. There is no telephone communication from Social Security informing you what to perform about taxation. You transition from a framework that operated on automatic control to a framework where every single determination is yours and every single error costs you money.
I've observed retirees forfeit thousands of dollars in their initial 2 years of retirement. Not because they performed anything incorrect, because they did not understand what the Internal Revenue Service anticipated them to perform once the paycheck halted. Right now, I'm going to provide you the complete listing. 10 items. All of them are significant. Most retirees overlook all of them. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. This is Senior SS Alert. Every week I explain the tax regulations, the financial dangers, and the tactics that safeguard retirees from the elements nobody else is clarifying. If that sounds like something you require, press the subscribe button immediately and activate notifications so you never overlook a video. Let us proceed into it. Number 1. Establish estimated tax contributions or you will settle a consequence. During your employment, your company deducted taxes from every paycheck. That deduction handled your income tax, Social Security tax, and Medicare tax. The framework functioned automatically. In retirement, your income arrives from various locations: Social Security, a pension, individual retirement account removals, dividends, perhaps rental income. And here's the difficulty. Most of those origins do not deduct sufficient tax. Social Security deducts a flat percentage only if you request it. And even then, it is usually not sufficient. Individual retirement account removals frequently have a default 10% deduction, but your actual tax proportion might be 22%. If you do not settle sufficient tax throughout the year, the Internal Revenue Service assesses you an underpayment consequence. The proportion changes quarterly based on the federal short-term interest proportion. For the initial quarter of 2026, the proportion is 7%. For the second quarter, it decreased to 6%. The consequence is computed daily on the underpaid sum for each quarter. The solution is to make quarterly estimated tax contributions. The timelines are April 15th, June 15th, September 15th, and January 15th. Navigate to irs.gov/payments and establish them. The Safe Harbor regulation states, if you settle 100% of last year's tax obligation through deduction and estimated contributions, you will not be penalized regardless of what you owe this year. 110% if your income was above $150,000. Let me place a dollar sum on this so you comprehend the stakes. State you retired in 2025. You are 66 years old. You collect Social Security, remove from your individual retirement account, and have some dividend income. Your total tax obligation for 2026 ends up being $14,000. You had $8,000 deducted through the year from various origins. That leaves $6,000 underpaid. You did not make any estimated contributions because nobody informed you to. The Internal Revenue Service computes the consequence on that $6,000 across 4 quarters at the current proportion. When you combine it all up, you're examining roughly $300 to $400 in consequence on top of the $6,000 you already owe. Now here is something most new retirees do not understand. The Internal Revenue Service does have a waiver, particularly for seniors. If you are 62 or older and you retired in the last 2 years and you had reasonable cause for underpaying, they can eliminate the consequence completely, but they do not implement it automatically. You have to submit Form 2210 with your tax filing and check the container for the waiver. If you just submit normally and settle the bill, you will settle the consequence and never understand the waiver existed. Number 2, submit Form W4V to deduct taxes from your Social Security. Most retirees do not recognize their Social Security benefits can be taxable. If your combined income surpasses $25,000 as a single submitter or $32,000 married submitting jointly, up to 85% of your benefits can be taxed. You can have federal income tax deducted directly from your Social Security payment by submitting Form W4V, Voluntary Deduction Request, with the Social Security Administration. You select from 4 flat proportions: 7%, 10%, 12%, or 22%. You can also establish this up online through your My Social Security account at ssa.gov. This requires 5 minutes, and it prevents the surprise tax bill that impacts millions of retirees every April. Number 3, comprehend the provisional income formula that taxes your Social Security. The Internal Revenue Service utilizes something named provisional income to determine how much of your Social Security becomes taxed. It is your adjusted total income plus any tax-exempt interest plus half of your Social Security benefits. If that number is between $25,000 and $34,000 as a single submitter, up to 50% of your benefits are taxable. Above $34,000, up to 85%. For married couples, the limits are $32,000 and $44,000. Those limits were established in 1983 and 1993. They have never been modified for inflation. A combined income of $25,000 in 1983 meant you were performing well. Currently, it is a modest retirement. This frozen limit now catches 56% of all Social Security recipients. Every dollar of additional income you generate does not just become taxed at its personal proportion. It can push more of your Social Security into the taxable zone. The effective marginal tax proportion for retirees in this income range can be 30 to 50%, because each dollar activates taxation on benefits that were previously untaxed. Comprehending this formula is how you control your tax bill in retirement. Number 4, claim the $6,000 senior bonus deduction. The One Big Beautiful Bill established a brand new deduction for taxpayers aged 65 and older. It is $6,000 per individual, $12,000 for married couples submitting jointly where both spouses qualify. This is on top of the regular standard deduction and the existing additional standard deduction for seniors. The income limits are $75,000 for single submitters and $150,000 for married submitting jointly. Above those limits, it phases out. Below them, full benefit. This deduction is available for tax years 2025 through 2028. It appears on the new Schedule 1A. Not all tax software is flagging this deduction automatically. Request your preparer particularly whether they implemented it. If you already submitted without it, you can modify within 3 years. Number 5, understand when your required minimum distributions commence and never overlook one. If you have a traditional individual retirement account or 401k, the Internal Revenue Service mandates you to commence taking minimum removals at age 73. These are named required minimum distributions. The sum is based on your account balance on December 31st of the prior year, divided by a life expectancy factor from Internal Revenue Service tables. You must take your initial required minimum distribution by April 1st of the year after you turn 73. Every required minimum distribution after that is due by December 31st of each year. If you delay your initial required minimum distribution to April 1st, you'll have to take 2 required minimum distributions in the same year, which can push you into a higher tax bracket. The consequence for overlooking a required minimum distribution is 25% of the sum you fail to remove under the Secure 2.0 Act. That decreases to 10% if you correct it within 2 years. But that is still an enormous consequence on money you were going to remove anyway. Here is a real illustration. You turned 73 in 2025. Your individual retirement account balance on December 31st, 2024 was $500,000. Your required minimum distribution for 2025 is approximately $19,200 based on the Internal Revenue Service Uniform Lifetime Table. You have until April 1st, 2026 to take that initial required minimum distribution. But if you wait until April, you also have to take your 2026 required minimum distribution by December 31st of that same year. That means 2 required minimum distributions in 1 calendar year, roughly $38,000 in individual retirement account removals, impacting your tax filing at once. That can push you into a higher bracket, make more of your Social Security taxable, and activate IRMAA surcharge assessments on your Medicare premiums. Taking your initial required minimum distribution in the year you turn 73 instead of waiting until April prevents the double impact. Number 6. Utilize qualified charitable distributions to satisfy your required minimum distribution tax-exempt. If you're 70 and a half or older, you can donate up to $111,000 directly from your individual retirement account to a qualifying charity. This is named a qualified charitable distribution. The donation counts toward your required minimum distribution, but it does not count as taxable income. It does not increase your adjusted total income. It does not push your Social Security into the taxable zone. It does not activate Medicare IRMAA surcharge assessments. If you were going to provide to charity anyway, routing it through a qualified charitable distribution instead of composing a payment from your banking account is dramatically more tax efficient. Same donation, different origin, thousands of dollars preserved. Number 7. Consider Roth conversions during the gap years. The years between retirement and age 73 before required minimum distributions commence, and potentially before you claim Social Security, are named the gap years. During those years, your income is frequently at its lowest. Your tax bracket is at its lowest. This is the optimal window for Roth conversions. When you convert money from a traditional individual retirement account to a Roth, you settle income tax on the sum you convert. But once it is in the Roth, it grows tax-exempt. Removals are tax-exempt, and there are no required minimum distributions during your lifetime. The tax you settle now at a lower proportion preserves you from a higher effective proportion later, when Social Security, required minimum distributions, and IRMAA all stack on top of each other. A down market like we are experiencing right now makes Roth conversions even more attractive. You convert at a lower dollar sum, settle less tax, and all the recovery expansion happens inside the Roth tax-exempt. Let me demonstrate you the mathematics. State you convert $50,000 from a traditional individual retirement account to a Roth while the market is down. You settle income tax on $50,000. If the market recovers 20% over the next 2 years, that $50,000 expands to $60,000 inside the Roth, completely tax-exempt. If you had waited until the market recovered to convert, you would be converting $60,000 and settling tax on the full sum. At a 22% bracket, the down market preserved you $2,200 in taxes over a decade of conversions. That accumulates to tens of thousands. The ideal tactic is to convert just sufficient each year to fill your current tax bracket without spilling into the next one. A tax consultant can assist you compute the exact sum. Do not wait. Every year you delay is a year of conversions you cannot retrieve back. Communicate to your consultant this week. Number 8. Observe out for IRMAA, the Medicare premium surcharge nobody warns you about. IRMAA stands for Income-Related Monthly Adjustment Sum. If your modified adjusted total income surpasses certain limits, Medicare adds a surcharge to your Part B and Part D premiums. The surcharge is based on your tax filing from 2 years prior. For 2026, the initial bracket commences at $106,000 for individuals and $212,000 for married couples submitting jointly. Above those levels, your Medicare premiums can increase by $70 to over $400 per month per individual. A single large individual retirement account removal, a Roth conversion, or one-time capital gain can push you over the limit for 1 year and increase your Medicare premiums for the next 12 months. If this happens because of a one-time occurrence, you can submit Form SSA 44, Medicare Income-Related Monthly Adjustment, some life-changing occurrence with the Social Security Administration to request a reduction. Number 9. Update your address with the Internal Revenue Service and never disregard their correspondence. If you relocated when you retired, the Internal Revenue Service may still be transmitting notices to your old address. Submit Form 8822 to update your address. This is complimentary and requires 5 minutes. Every Internal Revenue Service correspondence has a timeline. Overlook that timeline and you forfeit your right to dispute, appeal, or negotiate. The Internal Revenue Service does not consider your excuse. They consider the date on the correspondence. If you obtain a notice and you're not certain what it signifies, do not place it in a drawer. Open it immediately. If it is a CP14 notice, it demonstrates a balance due. If it is a CP2000, the Internal Revenue Service believes your filing does not match their records. If it is an LT11 or Correspondence 1058, it is a final notice of intention to levy, and the Internal Revenue Service can take action in 30 days. Number 10. Operate the numbers on standard deduction versus itemizing every single year. The standard deduction for 2026 is $16,100 for single submitters and $32,200 for married submitting jointly. On top of that, seniors 65 and older receive an additional $2,050 per individual, and on top of that, the new senior bonus deduction adds up to $6,000 per individual. For a married couple, both over 65, the combined standard deduction plus both senior add-ons plus the bonus deduction can surpass $47,000. That is a lot of income that is completely tax-exempt. But the SALT deduction cap just jumped from $10,000 to $40,400 under the One Big Beautiful Bill. If your state and local taxes plus mortgage interest plus charitable contributions surpass your standard deduction sum, you should be itemizing. Millions of homeowners switched to the standard deduction in 2017 when the cap was $10,000 and never examined back. The cap has transformed, but their submitting habits have not. Operate the numbers every year. Do not submit on automatic control. The difference between the right selection and the incorrect one can be thousands of dollars. Let me provide you a quick illustration. A married couple, both 67, residing in New Jersey. Property taxes $16,000. State income taxes $9,000. Mortgage interest $4,000. Charitable contributions $3,000. Total itemized deductions $32,000. Their standard deduction with both senior add-ons and the bonus deduction is about $47,000. Standard deduction wins by $15,000. They should not itemize. Now take the same couple in Connecticut. Property taxes $22,000, state income taxes $14,000, mortgage interest $8,000, charitable contributions $5,000, total itemized deductions $49,000. That surpasses their standard deduction by about $2,000. They should itemize, and if they have been taking the standard deduction on automatic control since 2017, they have been leaving $2,000 a year on the table. Over 5 years, that is $10,000 gone. The SALT cap transformation from $10,000 to $40,400 is the single biggest reason to rerun this computation in 2026. If you reside in a high property tax state and you have not verified since the cap was at $10,000, verify now. Let me bring it all together. Here are all 10 in order. 1. Establish estimated tax contributions before the next quarterly timeline. 2. Submit Form W4V to deduct taxes from Social Security. 3. Compute your provisional income so you understand how much of your Social Security is taxable. 4. Claim the $6,000 senior bonus deduction on Schedule 1A. 5. Understand when your required minimum distributions commence and never overlook one. 6. Utilize qualified charitable distributions to satisfy your required minimum distribution, tax-exempt. 7. Perform Roth conversions during your gap years while your tax bracket is lowest. 8. Observe for IRMAA and prevent one-time income spikes that raise your Medicare premiums. 9. Update your address with the Internal Revenue Service and open every correspondence immediately. 10. Operate the numbers on standard deduction versus itemizing every single year. 10 items. The Internal Revenue Service anticipates you to understand all of them. Most retirees understand 0 of them on the day they retire, and every single one you overlook costs you money. This is Senior SS Alert. If this video assisted you, press the like button immediately. It requires 1 second and it assists this video reach more retirees who require to hear it. If you are not subscribed yet, press subscribe and activate the bell so you do not overlook the next one. The videos I'm working on next could preserve you thousands of dollars. If you understand someone who just retired or is about to retire, transmit them this video right now. This is the task list nobody provides you on your last day of employment. Leave a comment. Which of these 10 did you not understand about? I examine every single one, and the most frequent questions become future videos. I will witness you in the next one.